Welcome to this explainer. Okay, today we're unpacking exactly why a seemingly boring, highly predictable government bond actually has the power to send your entire stock portfolio into a complete tailspin. I mean, it absolutely dominates financial headlines, yet it kind of remains totally misunderstood by most investors out there. So it's basically the ultimate financial mystery that we are solving today. What actually happens when the so-called risk-free rate becomes a direct threat to the stock market? Like, why on earth does the stability of a government asset directly cause absolute chaos for high-flying tech companies? Section 1. What are Treasury yields? All right, simply put, Treasury yields represent the interest rate that the United States government pays to investors who lend them money. They do this by buying government bonds. Now, here's the critical part. Because the U.S. government has literally never defaulted on its debt, this yield acts as the ultimate benchmark. It's known across the whole financial world as the risk-free rate of return. That means every single other investment out there, whether we're talking about a real estate trust, some hot new tech stock, or even a local business, it has to convince you, the investor, that it is worth taking a risk over this guaranteed risk-free payout. Moving on to Section 2, the competition for capital. I want you to imagine a fundamental tug-of-war for your money. On one side, you've got the risk-free rate of safe government bonds, and on the other, the future corporate profits of the, well, risky stock market. Because money is finite, right? So if the guaranteed government side gets more attractive, capital just mathematically drains from the stock side. Investors are constantly asking themselves, is the anxiety of crazy stock market swings really worth it when I can just get a guaranteed yield straight from the government? And that, my friends, brings us to the magic number, 12. Right now, these Treasury yields have hit their highest level in 12 months. They've reached this big annual peak, and honestly, it's setting off alarm bells for investors everywhere. Why? Because that gap between safe returns and risky stock returns has suddenly and violently shrunk. You've got to remember, this is a strictly mechanical relationship. In the bond market, bond prices and yields move in opposite directions. It's like a giant seesaw. When demand requires higher interest rates, like hitting a 12-month high, those existing bonds with the older, lower rates, they instantly lose their value. And that completely shakes up massive institutional portfolios. Section 3, the market chain reaction. Okay, here is exactly how this unfolds. Step 1, it usually starts with inflation or economic data coming out and showing things are running just a bit too hot. Step 2, that prompts the central bank, the Federal Reserve, to jump into action, keeping interest rates high to cool things down. Step 3, in response to that, the market pushes Treasury yields to climb right up to that 12-month peak. Now, step 4 is where the big money moves. Giant pension and mutual funds start rebalancing. Their portfolio managers look at their computer models and go, hey, safe bonds now offer enough return to hit our targets. They don't even need to take on the risk of stocks anymore. Which leads directly to step 5, massive stock selling. Large institutions literally dump huge blocks of equities just to buy those high-yielding treasuries. And boom, the broader market indices drop. So how does this squeeze impact the actual companies you're holding? Well, as borrowing costs increase globally, a corporation's interest expenses on their debt just absolutely skyrocket. Because money is suddenly so expensive to borrow, they slam the brakes on expansion. They stop building that massive new factory, or they completely cancel their big hiring push. Obviously, this lowers their future earnings projections, so investors apply higher discount rates, and inevitably, the stock price declines. It is a brutal but totally logical sequence. Section 4. Winners and losers. When the dust finally settles from all of this, the fallout is pretty clear. Growth stocks, primarily in the tech sector, are the biggest losers here, mostly because their value relies so heavily on distant future profits. Dividend stocks, like your standard utilities, they also lose out because investors just abandon them for those risk-free government yields. But you know who the surprise winners are? Everyday retail investors holding cash and certificates of deposit. Suddenly, they get to lock in these fantastic, meaningful, guaranteed returns without risking a single penny in the stock market. I actually want to pause for a second on why tech gets hit so hard. It really all comes down to this concept called discounting future cash flows. Basically, this is how investors figure out the value of a stock, by projecting its future earnings and then reducing them back to today's dollars based on current interest rates. Tech and startup companies suffer the absolute worst under this model. Analysts are using those current high Treasury yields to calculate the value of profits that won't actually materialize for, maybe 5 or 10 years? So when that Treasury yield, which acts as the discount rate, is sitting at a 12-month high, it mathematically destroys the present value of all those distant future profits. No way around it.
Section 5. Limitations and hidden risks.
Now, this system definitely isn't flawless, right? It has some serious built-in risks. First up is market overreaction. Stocks will often just panic sell way before the economic data even justifies it. Second is the time lag, meaning the actual real-world damage won't officially show up in corporate quarterly earnings reports for months. And finally, geopolitical variables. During an international crisis or, say, a sudden supply chain shock, panicked investors might actually buy both U.S. stocks and bonds simultaneously as safe havens, and that completely breaks the inverse relationship we just spent all this time building up. Furthermore, we can't ignore the looming threat of an actual economic slowdown. If these Treasury yields stay stuck at a 12-month high for too long, it stops being just a portfolio problem. It becomes a Main Street problem. The cost of borrowing becomes so universally toxic that it literally chokes businesses that are just trying to operate and consumers who are trying to buy homes or cars. And that risks a much broader, much more painful economic recession. Which leaves us with a totally fascinating and absolutely critical question to ponder. This entire system relies on government bonds being the ultimate anchor of safety. But if these safe bonds have the power to starve capital from the stock market, stall corporate growth, and ultimately trigger a recession, is the risk-free rate really risk-free? I'll leave you to think about exactly how safe that safety net truly is.